My job is to introduce your next speaker, and I'm absolutely delighted to be introducing Andrew Bailey, our Governor of the Bank of England. Andrew began his career as Governor in March 2020, following a distinguished career in the financial industry. Prior to becoming Governor, Andrew served as CEO of the Financial Conduct Authority from July 2016. And as CEO of the FCA, he was also a member of the Prudential Regulation Committee, the Financial Policy Committee, and served on the board of the Financial Conduct Authority. Please put your hands together and welcome Andrew Bailey onto the stage.
Well, thank you, and it's a great pleasure to be here today, to be here at the BCC's annual conference. And I think the program is a testament to the vibrancy and innovative spirit of UK businesses rooted in local communities. And I think that's very encouraging. And I really can't emphasize enough how important it is to me and my colleagues to hear from businesses and communities around the country firsthand. Now, we all benefit from the data and surveys, of course, including the informative recruitment and economic surveys that the BCC conducts. But conversations with people running businesses and organizations give us the stories behind the economic data. They help us to connect with what's happening on the ground in the UK economy, and I can't emphasize enough how valuable that is to us. And what we find, and what I find, is that businesses, and you all tell us about the local challenges you're facing before we see them in the official data, and that helps us hugely. And of course, that intelligence has been particularly vital during the uncertain times that we've been going through over the last few years, which I'm going to focus on today. It's also why we have our own extensive network of agents, regional agents, who work across 12, we divide the country up into 12 regions and nations in this country. And they spend their time talking to businesses and local organizations in all parts of the country. They are our eyes and ears, if you like, in local communities across the country. And all of those, the rest of us, and those of us who are on the Monetary Policy Committee, join them regularly. My commitment and what I do each year is that I visit each of the 12 regions and nations at least once a year so that I can hear directly from all of you and from businesses as to what's going on. And in fact, only yesterday I was in the southwest in and around Exeter. So whether it's as I was yesterday, for part of the time, on a family farm producing cheese in Devon, headquarters of a national supermarket chain in London, a major industrial production site in the northeast, there's always something that certainly I can say I learn from these conversations. Whether it's about our understanding of the labour market and employment, of the supply chains, the competitive environment in different parts of the country, all these stories help us to understand what's going on. And I always say to people when I do these sessions, when we're sitting in the Monetary Policy Committee meetings, we do bring these anecdotes and these stories directly into the meetings. It's quite common for one of us, me or one of the others, to say, I was somewhere and I was talking to this business and they said this and it seems to fit or it doesn't fit with what we're talking about. It really is invaluable. So I want to take the opportunity today to talk about the current position of the UK economy, drawing on all of that information. And obviously to put that into the context of the decision we took in the MPC last Thursday to increase bank rate by a further 0.25 percentage points to 4.5%. Now I have to start with a very simple and blunt statement. Inflation, of course, is much too high, and it's our job to bring it back sustainably to the 2% target, and that's what we're going to do. But I want to begin by describing the quite extraordinary situation that we find ourselves in. It's now over 3 years since COVID struck and, of course, changed our lives in many ways. And the virus first disrupted economic activity on a vast scale. We all remember it. It called for huge public policy interventions, ones really that few of us, I think, had ever thought we would see in our lifetimes. And then I think in subsequent waves, even as we learnt to adapt and benefit from effective vaccines developed at, frankly, record speed, what COVID did was to continue to contribute immense uncertainty, that is certainly for outcomes in public health, but actually for the economy as well. And it's striking that after a huge sort of drop off a cliff in the spring of 2020 and quite an initial recovery as the summer went on, the level of economic activity measured certainly by monthly GDP in this country has failed to grow beyond its pre-pandemic level on a sustained basis. It's still hovering around now the level that it got to round about in early 2022. And in the latest release in March, it fell a bit. Now that sets the UK apart from other advanced economies. Both the euro area and actually especially the United States have more than recovered the economic ground lost during the pandemic. Now that slow recovery here came alongside a series of big supply shocks that have continued to shape economic and inflationary dynamics in this country. I just want to run through them just very briefly because I think it's important just to lay them out briefly. So the first of these big shocks was a very sharp rise in the price of globally traded goods and global supply chains were overwhelmed by what was a quite persistent and not really expected shift in demand from services to goods across the advanced economies. But that shock has now considerably reduced and global supply pressures have eased. Now, the second big supply shock was caused by Russia's appalling war on Ukraine and its people. That had the effect of driving up wholesale gas prices in European markets, something I know all of us and you've all suffered from. And this has been the largest single contributor to CPI inflation in this country by some distance. While making up less than 1/20th of the CPI basket, electricity and gas have directly added up to 3.5 percentage points to overall UK inflation. Now, energy prices have now fallen from their peaks over recent months, and we do expect the effects of this shock will also now reverse. The third shock that I want to mention is a domestic one. As COVID had hit, UK labour supply growth came to an abrupt halt. The size of the workforce declined by more than 130,000 people, or nearly 0.5%, in the 3 months from December 2019 to the 3 months to January this year. Now, the primary cause of that reduction in labour supply is an increase in economic inactivity, not just reflecting the ageing of the population, which I have to sadly say was happening anyway, but also driven by a fall in the share of working-age people taking part in the labour market. And this has contributed to inflationary pressure. Now, in the most recent data, including the data released yesterday morning, there are some signs that this shock is now beginning to reverse, especially amongst younger people. The fourth shock is the one that I think possibly gets the most attention at the moment, and that is the sharp rise in food prices. A year ago, I did comment that disruptions to Ukraine's supply of agricultural products to the global market could drive up food prices to worrying levels. Since then, annual CPI inflation for food and non-alcoholic beverages in this country has risen from just under 6% in March 2022 to just over 19% in the latest, that's March of this year, number. Now, this is not just a phenomenon in this country. Other European countries have similar food price inflation rates. Increases in energy prices and poor harvests, in addition to Russia's invasion of Ukraine, have played a role throughout the European continent. These big external shocks continue to account for a large part of the inflation overshoot above target. Now, there's another effect here, because in worsening the terms on which we trade with the outside world, the rise in external prices has reduced our real national income. And this is being felt by households across the country, and most acutely by those on lower incomes. This inflation, which is concentrated more than usually in the essentials of life, fuel, energy, food, is hurting the least well-off even harder, because those staples are a much bigger share of their consumption than they are for those who are better off. And in my visit to Devon yesterday, I went to Citizens Advice in Exeter to meet people who are helping those at the sharp end of the rise in the cost of living. It's clear that many people face difficult choices and have had to cut back even on essentials. We know that higher interest rates make things hard for many people too. But we're conscious that high inflation always hits the least well-off the hardest. And our job is to make sure inflation is low and stable. So we have had to raise interest rates to bring inflation back down. Now, I'm going to push back against one argument that you do here, which is that inflation is high because monetary policy was too loose in the past. My colleagues Ben Broadbent and Silvana Tenrera countered that assertion in detail recently. And the headline I'll say is this: even if we had had the benefit of full hindsight in the run-up to the war in Ukraine and ample advanced warning, which for the record, of course, we didn't, I'm afraid, nobody did, then in order to keep inflation at around 2%, we would have had to raise bank rate well into double digits, sending unemployment much higher than it is today. We would have had to do that in the middle of the worst pandemic in more than a century. And the work that Ben and Silvana did shows that if we really could have followed this course on monetary policy, and let's say then that the subsequent increase in input prices, inflation, hadn't happened, inflation would have fallen steeply, well into negative territory, and real incomes would have suffered through lower wages as well as much higher unemployment. All of that's to say that monetary policy can't make this impact on real incomes go away. I wish it could, but it can't. What we have to do, though, is take action to ensure that inflation falls as these external shocks abate, and that the inflationary impulse that these shocks deliver does not cause persistent domestic second-round effects in wage and price setting that could hold inflation up for longer. And that's why we've increased bank rate by nearly 4%, 4.5 percentage points, from December 2021, when it was then 0.1%, to the 4.5% that it is now. Now, you may say at this point, thank you for being such a doomster. So let me say, things are looking a bit brighter than they did a couple of months ago. It's always good for me to come on and say that. We published our latest monetary policy report last week, but if I go back to the report we published in November last year, so exactly 6 months ago, at that time, we expected a shallow but long recession in the UK economy. In our latest last week's report, we're now forecasting modest but positive growth and a much smaller increase in unemployment. Now, what are the causes of that? Well, above all, the improvement in the outlook reflects a very large fall in wholesale gas prices. And that reverses some of the terms of trade shock that I was talking about and have been the primary cause of falling real incomes. But alongside that, there has also been a greater resilience in the economy than we had expected. And we can see that most obviously in the employment and unemployment numbers, which have been consistently stronger than we expected. Now, fiscal policy, I know you had the chance to come along earlier, fiscal policy has also given a boost to the economy, and global growth has been holding up better than we thought. particularly in the euro area, and particularly in China, which came through its ending of zero COVID, with fewer, I think, adverse effects than we feared might be the case. Now, at the same time, I'm afraid inflation has come in higher than expected, and much of that reflects the food price story I was just telling. The latest figure for March, 10.1%, was 0.8 percentage points higher than we had expected 3 months ago at the time of our February monetary policy report. Now, we do have very good reasons to expect inflation to fall sharply over the coming months, beginning with the April number, which will be released next Wednesday. Energy prices have fallen from their peaks, and that will start to come through as lower inflation. To give you a perspective on that, in the March release, the price of electricity, gas, and other fuels was more than 85% higher than a year ago, and that contributes more than 3% to headline inflation. We expect, and this is really mathematical, it's not behavioral, that that contribution will drop significantly to about 1 percentage point in next week's data for April, as those large increases from a year ago drop out of the calculation. And looking ahead to the end of this year, if energy prices evolve as financial market prices suggest they will, that contribution from energy will fall further. And towards the end of this year, energy prices should begin to pull overall inflation down rather than push it up as they have done over much of the past 2 years. Now, we can be less sure about the timing of global food price inflation, but we do believe, and all the food producers and food retailers that I talk to support this story, we do expect it to start to ease too. Global prices of wholesale agricultural commodities have come down since spring of last year, and food producer price indices have eased in recent months too. And the evidence that our agents get suggests that food producers expect food production costs to begin to moderate. Now, this is taking longer than we previously thought, but we should expect it to feed through to consumer and food inflation over the coming year. And that's the message I can hear when I go and visit food producers and retailers around the country. But, and you probably think I would say this, we need to continue to keep a watchful eye on other components of consumer price inflation. What we call core inflation, which excludes energy and food prices, the more volatile elements, is driven by items that can have a more persistent inflationary dynamic. And in the latest number for March, at 6.2%, core inflation remains elevated. Now, some of that elevation reflects the indirect effects of higher energy prices. But it also reflects second-round developments as those external shocks that we have seen interact with the state of the domestic economy. And as headline inflation falls, these second-round effects are unlikely to go away as quickly as they appeared. There's an asymmetry in there, if you like. And on the Monetary Policy Committee, we spent a lot of time on this issue, and we do think that this asymmetry is important in the inflationary dynamics that we're experiencing. So we do pay a lot of attention to measures and indicators of inflation persistence, and those include the tightness of the labour market, wage growth, services price inflation. Now, when you sum up all the news that we've seen on this front recently, it's quite mixed, really. There are some signs, and we saw it yesterday in the numbers, that the labour market is beginning to loosen a little. There's been some recovery in participation, especially amongst younger workers, and the number of vacancies has come down from the very high levels we were seeing. The ratio of the number of vacancies to the number of unemployed, which is a key measure of that tightness, has fallen as a result. I should say, though, from record levels of tightness, that is. Our agents report that businesses face fewer recruitment difficulties, that employees are moving jobs less frequently, and employers are getting more applications for job vacancies. But that easing of the tightness is happening at a slower pace than we had expected. And the labour market does remain very tight. The number of vacancies remains significantly higher relative to the number of unemployed than before the pandemic. And the figures for employment have been strong. Now, meanwhile, nominal wage growth and services price inflation have evolved much as we had been expecting. Nominal pay growth has fallen back slightly, and near-term indicators suggest that pay growth could ease further later this year. And that's backed up by what our agents hear on their visits. Contacts tend to tell us that pay settlements have been stable in recent months, and they expect the decline in inflation and the looser labour market to begin to reduce pay awards in the second half of the year. Services inflation is still elevated, however, and the extent to which firms have already passed through higher costs will influence the pace at which it declines. So while, as I said, we expect CPI inflation to fall quite sharply as energy costs begin to ease, though at a somewhat slower pace than we expected in February, given particularly the near-term outlook for food prices. The outlook for inflation further out is more uncertain, and it does depend on the question of persistence in wage and price setting. Now, we had a baseline projection in the report we published last year, conditional on actually what the market thinks is going to happen to bank rate, and the market thinks it's going to peak, at that point, thought it was going to peak at around 4.75% in the fourth quarter of this year. We do see some greater economic slack opening up. We do see the external pressures declining, and we do think that that will cause inflation to fall materially below the 2% target in the medium term. That was our baseline view. However, there's always a however, we do think that the risks to that inflation outlook are skewed significantly to the upside because of this risk of greater persistence. The unwinding of these second-round effects may take longer than it did for them to emerge, and we are in highly unusual times. Yet we don't have a sort of ready reckoner which says how the economy behaves in these sorts of times, given the shocks that I outlined earlier. And so we have included a material upside risk to the inflation outlook over the medium term. And what that means in summary is that, again, conditional on what the market thinks is going to happen to interest rates, in that view of the world, inflation still comes back to the target of 2% and stays around it, or just below it, in the second and third years of our forecast. So in other words, after the first year from now. Now, let me emphasize very clearly then, this upside risk doesn't actually call into question us getting back to the inflation target. But I think it's an important, in a sense, assessment of how we get back there. Before I end, let me just briefly go on a couple of other points. Changes in our bank rate appear to have passed through, as would be expected, into new mortgage and corporate borrowing rates. The pass-through into household sight deposit rates has been muted, but rates on term deposits and fixed-rate bonds have risen more in line with changes in bank rate itself. And I should emphasize that people should seek out the opportunities that a competitive market in retail banking produces to take advantage of those rates. Now, in recent months, overseas bank failures have resulted in asset price volatility, and spreads on UK banks' wholesale funding costs rose for a while. But it turned out in this country that was quite short-lived. We didn't see a lasting impact on interest rates facing households and companies. The UK banking sector remains resilient. It's got robust capital and strong liquidity positions. And in my view, it continues to have the capacity to support the economy and to support businesses and households. People should be able to rely on their banks. And that's important for us in setting monetary policy, because it means we haven't had to aim off in setting monetary policy because of the situation in the financial system. And that's an important thing to be in a position to do. Now, the changes that we have made in interest rates are still working their way through the system. We've seen higher rates quoted on new mortgages, and while the effective rates on new mortgage lending have been increasing, the effective rate on the whole stock of mortgages is still in the process of adjusting. The reason for that is that the mortgage market has changed substantially in the last 10 to 20 years. There is now a much larger share of fixed-rate mortgages in this country. So that as this process plays out, the rises in bank rate that we have put in place since December 2021 will weigh more on the economy. There is some more effect to come through that, and we factor that in very closely. And that was an important element of the discussion in forming our view that we should increase bank rates, as we did last week, to 4.5%. So we are continuing to address the risk of more persistent strength in domestic price and wage setting, as represented by this upward risk, if you like, in the distribution. We will continue to monitor very closely the indicators of persistence in inflationary pressures. And we will adjust, as we think is necessary, bank rate to return inflation to target sustainably in the medium term, as our remit tells us we should do. If we saw much greater persistence or more persistence, then we would have to undertake further tightening in monetary policy. That's our commitment. We will judge it according to the evidence. Thank you.
Andrew, thank you so much. That was a fascinating speech you just gave, lots in there. We're going to have a question from the press and 2 questions from the audience. But before that, I mean, you know, you've addressed the sort of strategy behind the interest rates rises. I just wanted to ask you if you're ever worried that there might be a danger in overshooting now, particularly when inflation is due to come down, which could choke off growth. That is an argument that I do hear from some economists.
Well, it's something that we do have we watch very carefully because we are, as I said a few minutes ago, in these completely unprecedented times. You know, we've had this huge run-up, obviously, in inflation. You know, I set out the shocks that were going on. And I'll just emphasize this point, that one of the things that we have spent a lot of time on is this question about, you know, will it be symmetrical? Will it be, you know, will inflation come down as we saw it go up, or will it take longer to come down? It will come down, by the way. And we have to judge that very carefully. And as you say, we have to judge the impact on activity in the economy and how much slack there is in the economy. And I think it's, you know, it's interesting. I mean, this is an encouraging story, I should say. As I said, you know, the economy has been more resilient, and particularly the labour market has been more resilient. Now, I should say I see that in many of the discussions I have with businesses around the country, because people say to me, a lot of people say to me, look, I found it so hard to recruit people that I'm hanging on to them, come what may, as it were. And that's logical, because a lot of people say to me, you know, if I have to make an adjustment, it will be more on the hours worked rather than on the number of people. Because I don't want to go through it again, having to recruit people once the economy recovers. And that's resilience, and that's a good story. And we take that into consideration. But just to reassure you, we do spend a lot of time thinking about the sort of, you know, where do you get the right balance in terms of what we do.
No, it's such an important point. That sort of labour market tightness is very, very important. I think we're going to take a media question. I think we're going to go to Bloomberg News.
Yeah, hi, Phil Aldrich from Bloomberg. Just a question about the credibility of the Bank of England. Obviously, you missed the inflation shock, and now we're raising rates more aggressively than you'd expected. And your forecast last week reversed a lot of what you were expecting in earlier months. So, you know, is the bank's credibility sort of up to the task?
Well, Phil, I do always make the point that our forecasts are conditional. They're conditional in the sense of, you know, we have to condition them on, you know, on financial market prices. We have to condition them on other policies, and then of course we have to adapt them for the shocks that are going on around, you know, in the world around us. And as I said earlier, the shocks have been huge, so we have to make these adjustments all the time. You know, I also made the point, you know, you probably detected quite strong in pushing back on this idea that somehow monetary policy caused this inflation, because I'm sorry, I just do not believe that to be the case. So our job and our credibility is to bring inflation back to target. And overall, this is the biggest test of the regime, because it's by far the biggest shock to inflation. But the test for me is that we can have these things going on in the world around us, which are, are terrible and have very bad effects, and the regime can bring inflation back to target. That's the test of credibility for me.
Interesting. Right, we'll take 2 questions from the audience. Does anyone have any questions for the Governor of the Bank of England? Yeah, I can see a hand up there, so in the middle of the room.
Hi there, it's Matt Moss here, CEO of Smart Garden Offices based in Suffolk. With businesses facing huge amounts of cost pressures with energy, taxes, employment rates going up, most of the influence around inflation is caused by external factors, global factors. How do you perceive the fact that increasing interest rates is another inflationary pressure that businesses are having to face, is another cost that we're having to bear? And when you talk about the longevity of this inflation, that's just adding more pressure and will add more longevity, and it puts a huge amount of pressure on businesses that have got existing finance where they're not perhaps then able to gain support from banking.
Thank you.
So I do understand the question, and I want to assure you that I do understand the very difficult consequences of the economic conditions and the inflation that we're facing. What I would say is this, and it somewhat continues from the previous question, that what would be a worse outcome is if we did not get the inflation under control. And I come back to this question about persistence and about second-round effects. I say consistent with my answer to the previous question. I'm afraid there's no tool that we have to make the initial shocks go away and to make the effect of these external shocks, particularly on national real income, which obviously then feeds through into the economy, comes through as inflation, go away. What we do have to do is prevent it becoming embedded. That would be a worse outcome. That's why we're raising interest rates in a sort of simple sense.
And we've got one final question from the gentleman at the front here. If we could just get a microphone to this gentleman just in this front table here.
Thanks. Rod Downer from the Industry Forum. This may sound like a simplistic question, but is there any point in having a 2% inflation target that you very rarely, if ever, meet because of other good factors, actually? But I mean, do you need a more complex mandate, or should you drop the 2%?
No, I think it's important that we have a simple and transparent target. When you say rarely meet, I mean, actually, we did have quite a long period when we were meeting it. Funny enough, actually, the average of inflation in this country for the decade before COVID hit was almost exactly 2%. That's the average, of course. It moves up and down a bit because things are always going on. Let me say just 2 things on it. One, the reason we have this target is, the reason we have a target and we have price stability is because I think it's very important for all of us, whether we're businesses or whether we're households, that inflation doesn't in its own right enter into our decisions. That in a sense we can sort of say, no, I can rely on it being stable. Why 2%? I won't go on at length on this question. There is a strong argument for having a small positive number. And the reason is, people say, well, why don't you set 0? That's obviously price stability. The problem with 0 is that, because I said it does obviously fluctuate, that negative inflation brings its own problems. I mean, particularly, people then tend to sort of delay taking economic activity, spending and so on, because they think, well, price may be lower to come, and that actually can be even worse. So there's a strong logic to having a small positive number, and that's really where 2 comes from.
And we're just about to wrap up. Just one quick question from me, Andrew. The independence of the Bank of England is something which we consider really important in our politics, but that was actually thrown into question over the last sort of 12 months or so. What are your thoughts on that?
Well, it's not for me to comment on the politics. What I would say, I think, is that some of the actions that we have had to take in sort of the other part of our activities, particularly on the financial sector, the financial stability, So what we had to do last autumn on the LDI problems, how we had to step in for the relatively small but nonetheless important subsidiary here of Silicon Valley Bank in March, I think it emphasises the importance of our independence, and that we take these actions and that we take them when we do, we take them rapidly, and we have the tools to do it, which is part of our independence.
Well, ladies and gentlemen, that was a fascinating discussion and absolutely brilliant to have Andrew here, who's incredibly busy. So we're really grateful for his time. A warm round of applause for Andrew Bailey.